That said, I think there's a lot of opportunity. I think that the tools to grow a strong business are becoming more and more available and more dynamic. There's a way to get through, but you can't tool your way or mentor your way into success. Capital is involved in that. And absent a partner that understands it, it's just going to be a little bit harder for a while.
So we had a ton of momentum coming out of COVID, out of George Floyd, with regards to companies making commitments and VCs making commitments to Black founders, and committing to do more to provide equity and opportunity for Black founders with regards to capital, resources, and et cetera. And I wonder if this is still the case. A year and a half, 2 years later, has that window closed?
I think that's a great question. I think a lot of entrepreneurs and emerging fund managers are asking it, whether or not they're going to take the leap. I think it depends on who you talk to. There's a few things happening right now in the fundraising climate that make it challenging writ large. A lot of it's like the financial uncertainty, what's happening in the US economy, and the US economy tends to drive globally what folks are thinking about in terms of startup and tech investments. There's a change, though, in attitude. I think we saw it really when Elon Musk took over Twitter, which seems like a cultural moment. How does that directly connect to how investments are being made? I think that a lot of folks were uncomfortable with the commitments, the social justice commitments that were made around sort of following the untimely passing of George Floyd. And they are leveraging market conditions as a reason to retreat from some of those commitments. We can't do this because there's not enough of X. No one was really asking people to make carve outs for Black and brown entrepreneurs. If you believe in them, if you believe in the track record or the evidence that's sort of played itself out in the US economy, Black and brown people tend to create their own businesses at overwhelming rates, sort of outstriping their white counterparts, and their businesses happen to be quite successful. They weren't asking for carve outs. They were just asking, consider my investment as for what it is, which is something that's of high quality, that addresses a very specific market need that you might not understand, but millions and millions of people sort of understand because I'm building against the issues that I know. Despite not asking for a carve out, that's how excuses are being made now to retreat to old behaviors. I should say, some investors, not all, but a good number of them have not ever really been daring in terms of where they've put their money. Venture capital, as a general matter, does not encourage people to be daring in terms of where they put their money. It's just sort of pattern matching exists for a real reason. It's rewarded in the industry. And I think there's a lot of that behavior that's returned in large part because, like I said, the macroeconomic conditions, and then examples of leadership that are giving people cover for changing their behavior. I would even add that, and almost immediately after some of the commitments were made, we saw the founder of Basecamp. We saw a ton of founders who decided that they were going to take politics out of their businesses. Sort of another way to suggest that we're not making those types of commitments. Meritocracy is the thing that matters the most. Also, no one was debating that. But so sort of there have been, I should say, immediately after George Floyd, but even now, there are more and more excuses for people to go back to their old behaviors. So it's changed.
So you touched on a couple of these points, and I wanted to isolate them with this question. Like, what long-term effects related to the commitments made or the initiatives after COVID and George Floyd can be found? Are there any positive things that can be, realized out of those commitments?
I think so. I mean, it's sort of like human behavior tends to operate in a bell curve. Right. And so in the early days, it's like, oh, something's happening. Should we make a commitment? There's a spike in commitments. And then there's a reaction to that spike. I think as a result, in 2020, we saw a ton of people who had the courage to step out in really big ways and raise rounds. And whether or not founders got investment because of the societal moment we were in, or just because people were finally paying attention, I think there are a lot of great companies that have come out of that and had really incredible rounds as a result of it. I think that the challenge for everyone, and I think a lot of skeptics at the time were asking, how long would this commitment stick? I think that that's where the pessimism comes in. That said, I think that we'll see that batch of companies that raised money in 2020, 2021 was a really big year. Things started to get dicey toward the end of 2021. We'll see how they make out over the next 5 years. And I think that that's when they'll really prove themselves out about how valuable those early commitments actually were.
You've spent a lot of time working with corporations and helping, provide bridges for startups to work with big corporations. And how do corporations treat carve outs? I think about a lot of state and government, carve outs where maybe a state will designate 20% of its dollars have to be spent with, a minority owned company, or some companies will have prime vendors and sub vendors, and you got to work with the prime if you want to get, in it at all. So, how do corporations typically work in this regard?
I think actually, for whatever reason, perhaps because they're publicly traded and therefore publicly accountable, they're doing a bit better. A lot of corporate leaders don't see it as a carve out. You've got folks that are coming in and really want to align their investments with their consumer base, which trends right to groups that tend to be underrepresented in the venture world. I think that those that are successful navigating corporate innovation teams, the sort of purchase managers at corporations, are faring a bit better than those in the private markets, and that really might be about the length of a commitment a company is used to making, or the folks that are sponsoring the work within.
What are better ways corporations should think about how to engage with minority owned founders? Because a lot of the times it gets put on like, we may not have the capacity to do
I
business.
understand. Yeah, that's a really tough one. I think that some companies have done interesting things like ramp ups. They've partnered, you know, sort of partnered people that they want to do business with smaller chunks of the business, and then grow with them. Maybe move them from early entrants into their ecosystem to preferred partners. I think that folks that are planning for the long term do really well. There's a really interesting effort by Ariel Capital out of Chicago. This is the John Rogers and others. They're focusing on investing in companies that I believe it's like have 10 million ARR, Black owned companies at 10 million ARR, and boosting them up. And the powerful thing about their initiative is that Ariel Capital does a lot of work with some of these larger corporations, and their ability to pull in mid cap or sort of slightly larger than mid cap Black owned companies to do their work is a great opportunity. That early day of like small business interacting with a big company is difficult for everyone. They don't speak the same language. I think that what companies that are trying to be successful at it are doing is really creating more intermediaries or opportunities that smaller companies can grow their way into taking advantage of. And then partnering with larger entities that are calling them to see sort of mid cap or higher mid cap companies that can service them directly. Because they are there. I think that people talk about Black businesses as these really small things all the time, and that's not true. There are really, really incredible companies that have global contracts and have been around for decades that deserve their due.
And so it's no surprise to anybody listening to this that we're having, a real strong conversation about banking in the United
Mm.
States and the implications of bank collapse and over leveraging and all these different things. What lasting implications might it have for startups when a bank collapses?
Yeah, I mean, if we think about what we just went through with SVB specifically, which I paid really close attention to, I think the challenge for the market, and that's despite background, excuse me, is going to be it is hard when you're a small business interacting with the standard banking system, and the power of a partner in the case of SVB that really understands funky cash flow, really understands the early elements of an idea and how to sort of reconcile whether or not that deserves an investment that's not simply about that's not simply venture, right? A short-term bridge loan or a line of credit or all these other things. Absence of that deep understanding of the ecosystem is going to be a problem for a long time, I think. I mean, fundamentally, um, there are a lot of big banks that try really hard and have a plethora of programs. Chase is really a great example of that. That's targeting small businesses. But in innovation, where you're starting with just you and another person, an idea, your first or second purchase order, that's not enough for banks to really make a bet on you. You really need someone that knows what they're looking at. And so, in the absence of that, I think we're seeing some of the challenges right now. Typically, when the venture market is a little bit slower in terms of deal flow, and depends on the sector that you're in, it's a little bit slower. Um, you can go to the private markets for credit, but because as a general matter, people are concerned about the U.S. economy, it's harder to get credit, as a general matter. And so, what would have been easier, I found it easier for some businesses that I worked with as recently as last year to talk to a banker about giving us a line of credit to float us in the shortfall. Had really great revenue, but we're really trying to extend our runway a little bit, or just have something in the back pocket in case we came up against a challenge. That partnership is not there. The longer it takes a founder to go into the market to find capital to meet their need, is more time they are away from solving the problem for the customer that they sought to address. So it's not just that there's the absence of somebody that understands. The harder it is to find capital, the harder it is to grow a company really successfully. And so I think that for a while we're going to see there'll be sort of tough times for smaller companies that are on a growth path. That said, I think there's a lot of opportunity. I think that the tools to grow a strong business are becoming more and more available and more dynamic. There's a way to get through, but you can't tool your way or mentor your way into success. Capital is involved in that, and absent a partner that understands it, it's just going to be a little bit harder for a while.
One of the things I saw pervade my Twitter timeline when SVB collapsed was that it was propping up, and banks in general and VC in general were propping up startups that actually didn't know how to make money. And so people were saying, we got to focus on actually getting dollars in the door versus just venture capital, angel dollars, and et cetera. And I wonder what your take is on that. Do we have enough of our startups actually trying to sell something?
I think that they're just like all these places, right? They say there are levels to this. There are some people who were really getting by raising capital as a way to do payroll,
Yeah, yeah.
right? I don't know. I know some of them. I don't know a lot of those people personally. Everybody I know that started a business needs to cut a check today. Like someone is paying them, they're putting it in the bank, and they're pushing that money out. Yeah, I mean, listen, I think that venture, and I love the space, even though it sort of creates heartache. It's a really interesting industry to be in. The fact that could be the case. There's a period where it was about innovation, that real innovations, inventing the internet. It takes time, right? And so it's okay for you to go round after round to get capital to be able to hire the people to do the thing you need to do for the major breakthrough. But over the last few years, sort of the railroad tracks of innovation are already there, right? But the mindset was outdated. And so you had a lot of people that were, you had grocery companies. I don't know if I should name some of them, but yeah, GoPuff is a big example, right? Who are sort of burning cash, right? And it's like, well, this is groceries. You have a product, you give it to a person, they give you money, fair exchange, and they still weren't sort of making ends meet. Sort of got the old idea of sort of patient, I shouldn't say patient capital, of like letting venture capital be the cash flow mechanism for companies, and then having companies be surprised when the music stops, I think existed for some certain people. I think for others it just didn't. The last few businesses that I built don't operate that way, right? Like, they can hit 7 or 8 million ARR without ever talking to a venture capitalist. And then even in those instances, with healthy revenue and years of experience and a solid book of business, have trouble getting lines of credit from banks. I think that like the music stop for a certain group of people, it will impact some. I'm mostly concerned about the biotech industry. I'm hoping that investors, I don't spend a ton of time there, I spent some time there. I'm hoping that investors sort of don't look at the challenges that the industry has had in the same way. Biotech is a long lead thing. It needs cash for a long time before it even proves whether or not it can bring something to market. So listen, I think for every person, it's going to be different. My hope is that it's not in some sectors. And for others, the music deserves to stop.
Yeah. And so let's imagine, because you just talked about some things about venture capital have to change. Let's imagine venture capital is a patient going to the hospital, right? And it's got a broken leg, broken finger, and it's bleeding out.
Lots of problems.
Lots of problems. Some more severe than others. We know a lot of things could be broken about VC. What's the part that's bleeding out that's like, yo, we got to fix this before we focus on the leg and the broken finger?
That is a great question. That is a great question. I think that the most urgent challenge, or the thing that comes to mind most immediately, is risk aversion. So it's like venture capital.
Even in today's climate.
Yeah. I do. I mean, it's like everything's falling. Perhaps you should operate more in a more safe manner. But I'm hoping that um, sort of comfort, the risk tolerance, I should say. I said risk first, but risk tolerance essentially. Um, I hope is something that the industry fix fastest. The way I will break this down is that what you are rewarded in venture capital not necessarily by companies that go the full distance. You're most immediately rewarded by whoever picks up that company in a following round. So as a result, when you write your first check, it doesn't matter how much you have conviction in that one founder. You are always thinking about when they leave my office, when this round is done, well, the next group of investors that they have to convince say yes. And as a result, you can imagine when you think about the industry and the makeup, folks get really, really tight about the definition of a founder that will do really, really well in that environment. And you hear it all the time in investment committee meetings. People get really, really excited, but the thing that stops them is like, I don't know how this founder will do when they go out to raise additional capital. And that is where I feel like that is the bleeding out part of venture that I think stops it from going as far as it could go. Right. I think there isn't, if we were more risk tolerant, if we were more comfortable with the fact that and we knew that our colleagues are more comfortable with taking risks on what they on what could be great, on what a good company looks like. Look at the bones of the idea and be more risk tolerant to the individual. I think that'll help us go further. Because at the end of the day, no matter how much capital you raised, you have to deploy it. And you have to deploy it into companies that can actually have delivered to a customer, that can grow successfully ad infinitum, right? Dot, 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 right? And I think that the real challenge for us is a lack of imagination and an inability to take on risk beyond what we think our colleagues might be interested in order to sort of, make a big bet. I think that's the biggest challenge. We won't invite more people into our industry. The deal flow will get tighter. The range of founder that gets funding will get smaller. The more we're sort of confined by who we think our friends will like in the next round, as opposed to the validity of the idea itself.
Okay, that's good. You talked about some of the things that Silicon Valley Bank filled the gap in, with regard they understood how financing works for a lot of startups. Who fills that void now?
I don't really know. I think that remains to be seen. I think it's an exciting opportunity for anyone who wants to make a market. It takes some time. I would ask myself, like, where are the people who are at Silicon Valley Bank? What are they doing now? What do they want to do? It would be interesting if a group of them started something new. During the crisis itself, Brex did a lot to fill the gap. It's a little bit different because, as far as I understand, Brex is like a fintech company. It's not sort of a proper bank. Um, um, I think that they do know the startup ecosystem exceptionally well. It was a really good moment for them to bring in new customers. We talked a lot about startups, but it doesn't just affect startups; it affects fund managers, which are startups themselves, right? They're businesses themselves. Um, it will be interesting. I think it's a really great opportunity for folks that want to pick it up because there's a real gap in the market. Even Brex at its best, the more products that it spins out in the absence of SVB, it won't be enough. There isn't a single institution that should cover all of the bases there, and I'm excited to see who fills the void.
So we've talked a lot about the actual banking relationship, but one of the other things that we're hearing a lot about is interest rates and its impact on how people spend their dollars, how much discretionary income people may have. But what should a startup be thinking about? Maybe having pre-raised money or having raised money. What should startups hear when they hear interest rates going through the roof?
Yeah, so I'm not an economist, but I'll do my best here. My sense of it is that lower interest rates sort of allows people to be flush with cash. They're more dynamic in where they place it. Higher interest rates gets people to be really specific about where they place their capital. I saw a post recently, Jenny Fielding, who runs the fund. I think they're calling themselves Everywhere Ventures now. Is telling founders that act as if this last round is the last capital you'll raise. um, I don't know enough to say if it should be um, that dire, but it's fair, right? You should be really intentional about where you put a dollar. You only can spend it once, and we don't know what you know what future rounds will look like if they will be the same size as they once were. In large part, after SVB, there was like a pause, and the people went back to business. Things seemed to be fine because people had access to their capital, but there is more and more churn and chatter about the size of rounds being a lot smaller than once expected. So if you're building an expensive company like logistics or grocery stores, for example, and you sort of mapped out how much money you might need to raise at each step, you might find yourself in a tighter position than before. So just be aware.
Given that we're in this financial market like we're in now, how do VCs behave differently in markets like this when banking is, in, sort of awry, interest rates are doing something different? How do VCs behave differently when they're thinking about who to invest in?
I think they become more conservative, like we all do, with our money. At the end of the day, everyone has a boss. Venture capitalists, their LPs are looking at them in terms of the returns they can generate. People get more conservative. I think that folks will do that. I think that the venture capitalists that do really, really well will get really, really specific in their thesis, hyper focus in an area, so that they make choices that they really can believe in. And when they make risks, they have strong conviction about why they're making them. And actually, that's a lesson to us all. Where you put your money should be in the places that you think matter the most, and double down in the areas that you think are really important. If saving for retirement is really important, this is the time to spend all of your free time really understanding a bit about where you're putting your money in that regard. It'll help you make the right choices in the moment. So I think that the same thing, the way to think about venture capitalists is the way we all are. Everyone has a boss they're held accountable to. They've taken capital from other people. Their responsibility is to deploy it with return. And I think that the folks that do well will be open to risk in their very specific sectors that they know really well.
I've talked to a few different founders who recently on this podcast who were super successful in raising money during COVID when we didn't even know what the world would look like coming out of
Wild,
COVID.
right? It's
And
crazy.
yeah, and I wonder, with this current climate, is it still a good time to raise, or how do I know if this is a good time to raise?
You don't have a choice, right? Like you really, there isn't a perfect time for anything. I think that the COVID moment surprised a lot of us. The world is ending, and yet it's easy to get capital. The world is ending, and 10 people just bought a house. It is a really wild moment. You really, I mean, if you're a founder and you're building a company, I think that, let's see, what are the risks of you beginning to put feelers out there, starting to raise money? If you're unsuccessful, you stop the race, get feedback, make an adjustment, figure out what's wrong. If you are successful, no love lost, right? If you're not as successful as you thought, you have capital, and then what do you do, right? I think that, we can try to pick our moments and the best moment to do this. If the next level of your business requires capital, the best thing you could do is move in that direction, right? And the only thing failure will teach you is how to do better next time. I don't think that there's any way to hesitate or resist there. As a general matter, if you're thinking about maybe I shouldn't raise at all, maybe I should tweak something in my business, I think it just really goes back to the things you learned back in the day with your mom or your dad, which is really like, spend money what you have, try to keep as much reserves as you possibly can, and try to be smart about the choices you need to make. Over communicate with your team who are in this with you and who are equally nervous because their jobs are connected to the choices that you're making. But I don't think there's no really way, as they say, to time the market. You
Yeah,
got to do what you got to do.
yeah. And I've heard it said, or maybe I said it myself. I don't even know who said this, but I mean, it's always a good time for good companies. Like the good companies don't necessarily have to think
That's
about
right.
what the market looks like. And I wonder if that apprehension or the potential apprehension to consider the time, does that tell you more about the founder that maybe they're not as confident, or what does it tell you?
No. Yeah. I mean, you mean if a founder delays raising now, what does that
Yes,
tell me?
yes.
It could be a lot of things. I remember there are moments where, we were building a business, and our CFO was a fractional CFO, worked with lots of other companies. Um, just it was a good time to raise money. We had money. We just wanted a little bit more leverage. Discouraged us from raising money because our priority at the time, you only can spend 1 minute, one time, one way, needed to be the fundamentals of our business, right? It was going to make or break us in the long term. And sure, we knew exactly who to ask for money, and we were probably going to get it, and we decided not to. So sometimes founders decide not to raise because they prioritize something else that they think is more significant in their long-term success. It doesn't tell you much of anything. There are some founders that, I have moments where I talk a good game, and then when it comes time to do it, I'm nervous about it. Like there are some founders that are people, period, who are going to hesitate because of confidence. I think that that's not a problem. That's not a character flaw. That's not a suggestion that they're not good at their job or their business. It's a scary time, right? And fear can be a great motivator if they're connected with the right person. So I talk to founders. I try to be as open and as helpful as possible. And so you don't have to come to me as a perfect founder. We can talk our way through it. It doesn't really tell you much except that they're human and they're reading the tea leaves and they're being realistic about, whether or not this is a good use of or investment of their time.
And so I want to ask you about, because you spend a lot of time, again, working with big companies and helping them build those bridges with startups. I was reading this list that Michael Seibel from Y Combinator had put out, and it was a pocket guide for essential YC advice. And this was one line in this.
Saw some of those lines.
Yeah. And this one line piqued my interest, and it said, avoid big company corporate development queries. They only waste time. And it got me thinking about something I do. I have a marketing company outside of this, and I got to thinking about, I don't even respond to corporate or governmental RFPs because they take so much time to respond to them. And typically the resources put in, the investment put in is not worth the reward.
The
and
reward.
So I wonder what your thoughts are on this idea.
With everything, it depends. I respect Michael. I know your experience is real. You're a master entrepreneur yourself. And I've seen it. It depends. What if I told you that the decision maker in there was like my best friend of 20 years? Do I not do it? It just really depends. Correct. People, here's the thing. Everyone will waste your time if you let them. Number one. Number two, lots of people together operating as a group will definitely waste your time if you let them. And that's the case of companies. I think it depends on what you're going to get. Say you and I were building a business for 5 years, this marketing business, and we decide that we're going to get put into this. We're going to put into the RFP. We've met 3 people that we think could influence the decision at Nike, for example. And we're doing it because it's probably going to be a loss leader. It's going to take a lot of work. We're going to service this business for 3 months because the long tail, the ability to be able to say that we had Nike as a client is going to accrue to our benefit on the long term. We're not going to make this our whole business. If we've been running a business for a while, we can make that choice. I know a founder who is a really incredible marketer, has an innovative way of doing it. Most of her team is part-time. She's got Disney as a client. She has Vogue as a client occasionally. There are times when a business can be a lot more trouble than it's worth, but in par for the course, she's gotten to meet the M&A teams of these. So it really is about what the life cycle of the business. Where I think Michael's right is that starting a business where you're going to have a few clients and that's going to be the thing that you chase is probably problematic unless you came from that industry. This is the same playbook for any B2B business, and have the relationships to get you in the door or over a few hurdles faster. It really depends. It's wise advice because they can take a lot of time, but strategically they can be worth it. It's the same reason why, you might join a board, right? And not an unpaid board. It's like, actually, everyone on here, I'm going to probably raise money from in a few years. So that's it's like you're making an investment that doesn't really show out right away, but could be a long-termly powerful. Ultimately, though, I will say to our corporate friends, they know they have challenges interacting with innovative and small businesses. They know they need our innovation. They have teams thinking about it every day. It's probably part of the problem. They know that this is a thing that they want to get better at. They're not there, and they admit it. And I think that that's just sort of everybody's got their problems.
And to that end, let's go one level deeper. What is some of the pre-work that not enough of us do to make sure that when we do respond, we're better positioned to win those deals?
Yeah, I think that enterprise clients, as a general matter, are different than everyday consumers. They, despite knowing that you're a young company, will expect a lot of you. Typically, they're going to ask you for insurance requirements that you might need to be ready for, professional liability insurance. Ask your founder friends. There's probably a great recommendation they can make for you. You can get it cheap and quick. But these insurance people are used to getting these calls last minute from small businesses because it happens a lot.
Yep, I've had to do it.
Yeah, right. It's always a surprise. It's always a surprise.
Yeah.
And someone's frantically text messaging someone again. It's fine. I think that Understanding that when you're doing an enterprise client or working with them, you've actually got two jobs. There's delivery of the work, and then there's sort of delivery of the client, like managing them and helping them be a success in your story. I don't think it's specific to us. I think that the more you have exposure to servicing enterprise clients, or the more you can find people in your network who have experience doing it, the easier it is to figure them out and navigate them. As long as you've got a strong website, a clear path to issue invoices on time, and you know how to, and you figure out how to manage your client through milestones in your contract, you're going to be fine. There are little sort of tips and tricks they'll ask you when you sign up, but all those things, some of them you can kind of float through. They don't really care. You'd be surprised.
Yeah, and for those companies who are working through their internal challenges to onboard startups, and particularly Black founders, I mentioned earlier that too often we get put in the we don't have the capacity sort of bucket. What are, because you've done this work, what are some of the strongest cases you found that are effective in helping big companies see startups as potential partners versus risks?
Yeah, almost always the opportunity lies in some innovation that the big company cannot pull off on its own. And even the most innovative companies, the advantage that a small company has, that a big company does not, is that based on your height, you're closer to the customer. So, say the customer is like this height and you're this tall, and the big company is that tall, you're just so much closer to the sensitivities of a customer, to sensitivities of the market that they don't feel because they're too massive. There are insights you can bring that it would take their best team weeks and weeks to do desk research to figure out because you're living the reality in every day. And so I would kind of flip it a little bit. I would say to small and medium businesses to assert your superpower, which is really the you are eating what you kill, and as a result, you know where the fish are, right? And there's sort of and you really got to assert that and connect it. The other thing I would suggest, which I see a few companies do this, particularly in marketing, less in some of the more durable like hardware businesses do, but it is possible. Team up with someone in the business that you admire to go after the big business. So if you get a feedback about capacity, right? Well, your marketing business can be paired with another person in the market who might be a competitor. Like you guys are good friends. They're kind of in your space. You respect what they do, but you're running two different businesses. There's a lot of relationships like that. Come together and go after the business together and figure out how you guys are going to manage it through, especially if the contract could be something that, as I said, is a long-term value as you market your services to the clients you've been serving or to even other larger organizations themselves.
Maisha Leek, my friend, so good, so good.
It's great to see you. I love what you do. I'm so grateful that you do it.
Thank you so
I don't
much.
think that there's another space to tell these stories about what we're building, and it's super, super necessary. So every day that you get up and do this work, just know that there are a ton of us rooting for you, and we're just so happy that
That means a lot.
that you continue to tell our stories, and we're really grateful to you for it.
That means a lot. That means a lot.